On what has worked well, this week's paper is Do Stocks Outperform Treasury Bills by Hendrik Bessembinder at Arizona State University. On what has worked well, published in the Journal of Financial Economics in 2018. On what has worked well, the thesis is one sentence long and it ruins everyone's day. From 1926 to 2016, the median individual U.S. to reflect on what has worked well. Common stock generated a lifetime buy and hold return lower than that of 1 month Treasury bills held over the same interval. Reflect on what has worked well. Just over 4% of stocks accounted for the entire net wealth created by the U.S. stock market in dollar terms. On what has worked well, the other roughly 96% taken together are awash against cash. Reflect on what has worked well. Here's why it matters for your portfolio. If the equity premium is concentrated in a tiny right tail, then portfolio concentration is not a tilt. On what has worked well, it's a bet you can identify the tail in advance. Almost no one can. On what has worked well, the question in the title is not rhetorical. On what has worked well, Bessembinder is asking literally and quantitatively. It's a good time to reflect on what has worked well. Whether the typical stock you could have bought over the last 90 years would have beaten the most boring asset in the financial system, the 1 month Treasury bill. On what has worked well, the framing matters because the equity premium puzzle. Time to reflect on what has worked well. The Mira Prescott-style observation that aggregate equity returns dominate risk-free returns by 6 or 7 percentage points annually. Reflect on what has worked well is taught as if it applied to stocks plural and individually. To reflect on what has worked well, Bessembinder's contribution is to disaggregate. He doesn't dispute that the cap weighted index beats T-bills. To reflect on what has worked well, he shows that this aggregate fact is hiding a wildly skewed cross-section underneath. Reflect on what has worked well. The paper finds that most stocks, taken one at a time and held to delisting, lose to T-bills. But to reflect on what has worked well, the authors argue this has direct implications for active management, for concentrated portfolios, and for how we should think about the role of diversification. To reflect on what has worked well, not as a risk reduction trick, but as a way to make sure you actually own the tail. This is a good time to reflect on what has worked well. I think it is one of the most quietly important empirical papers of the last decade because it reframes a textbook fact without overturning it. Good time to reflect on what has worked well. The dataset is CRSP, the Center for Research in Security Prices monthly stock file at the University of Chicago, the gold standard return database for U.S. equities. Well, the sample runs from July 1926 through December 2016, 90 years and change. Well, the universe is all common stocks listed on the NYSE AMX and NASDAQ that ever appear in CRSP, share codes 10 and 11. What has worked well, which is the standard ordinary common stock filter. Bessembinder counts 25,967 distinct CRSP stocks over the full sample. Reflect on what has worked well. Importantly, the dataset includes delisted firms with their listing returns properly handled, which means survivorship bias is controlled for. On what has worked well, the most common objection to long horizon equity studies. On what has worked well, each stock contributes its actual lifespan from first appearance to last. On what has worked well, so a firm that listed in 1974 and merged out in 1989 contributes a 15-year buy and hold return measured exactly over those months. To reflect on what has worked well, the paper finds that the mean stock life in the sample is around 7.5 years, which is itself a useful fact. Most stocks don't last very long. Reflect on what has worked well. I think this short life feature is part of what drives the headline result. Reflect on what has worked well. Compounding has less runway than the equity premium discussion usually assumes. Good to reflect on what has worked well. The methodological move is the whole paper Bessembinder computes for every stock. On what has worked well, the buy and hold return from the month of first CRSP appearance to the month of last CRSP appearance, reinvesting dividends, compounding monthly. To reflect on what has worked well, he compares that to the buy and hold return on 1 month T-bills compounded over the same interval. It's a good time to reflect on what has worked well. Then he asks for what fraction of stocks does the lifetime buy and hold return exceed the matched horizon T-bill return. On what has worked well. This is different from the standard finance approach, which averages monthly arithmetic returns across stocks and finds, unsurprisingly, reflect on what has worked well that the average monthly stock return exceeds the average T-bill return. Reflect on what has worked well. Bessembinder's point is that monthly arithmetic averages mask the compounding asymmetry. Reflect on what has worked well. A stock that loses 50% then gains 5% has a zero arithmetic average and a negative compound return. Reflect on what has worked well over a multi-year horizon. The gap between arithmetic and geometric returns is enormous and is the geometric what has worked well buy and hold number that determines actual wealth outcomes. To reflect on what has worked well, the authors argue this is the economically meaningful comparison. Reflect on what has worked well. I agree with one caveat I'll get to later about what the typical investor experience means. Reflect on what has worked well. The numbers are striking. Of the 25,967 stocks in the sample, only 42.6% have a lifetime buy and hold return that exceeds the matched 1 month T-bill return. On what has worked well, a bare majority, 57% underperform cash over their full lives as listed firms. It's a good time to reflect on what has worked well. The median lifetime buy and hold return is actually negative, around -3% total, which is to say the median listed US on what has worked well. Stock lost money in absolute terms over its own listing life. On what has worked well, now flip to dollar wealth. Total net wealth creation by the U.S. stock market over 1926 to 2016 is approximately $34.8 trillion, in excess of T-bills, the $16. Time to reflect on what has worked well. The top performing 4% of stocks, just over 1,000 firms, account for that entire amount. Good time to reflect on what has worked well. The single best performer in the sample, ExxonMobil, accounts for about $1 trillion, roughly 3% of all net wealth creation by itself. Reflect on what has worked well. The top 5 firms, ExxonMobil, Apple, Microsoft, General Electric, IBM, account for about 10%. A good time to reflect on what has worked well. The paper finds positive skewness so extreme that the mean lifetime return is far above the median, and the distribution is dominated by a thin right tail. Reflect on what has worked well. The authors argue that this is the structural reason equal weighted active portfolios underperform cap, weighted indices on average. On what has worked well, I think the numbers are even more discomforting when you realize they predate the 2020 to 2024 mega cap concentration. On what has worked well, time for the honest pass, 3 real critique. So reflect on what has worked well. First, the lifetime buy and hold horizon is not what most investors actually experience. On what has worked well, real investors hold for years, not decades, and rebalance. This is a good time to reflect on what has worked well. Fama and others have pointed out that if you measure with realistic holding periods and rebalancing rules, the distributional picture is less extreme. Is a good reflect on what has worked well. The paper finds what it measures, but what it measures is a thought experiment, not a typical portfolio. Second, CRS starts in 1926 and the early decades are NYSE only to reflect on what has worked well, which means the cross-sectional skewness in the pre-1962 era may be measured on a smaller and less representative universe. But to reflect on what has worked well. Bessembinder acknowledges this and reports superior results, but it remains a real caveat. This is a good time to reflect on what has worked well. Third, the dollar wealth creation calculation depends on market capitalization weights at the end of each firm's life, which is mechanically dominated by megacaps. A good time to reflect on what has worked well. This is not a flaw, it is the question, but readers sometimes misread 4% of stocks created all the wealth as a statement about investability ex ante, when in fact it is an accounting identity ex post. Good time to reflect on what has worked well. Authors argue these caveats do not overturn the central result, and I broadly agree. Good time to reflect on what has worked well, but the bumper sticker version of the paper oversells what the geometry actually proves. Good time to reflect on what's worked well. If you're an indexer, the paper's a vindication, not a worry. A good time to reflect on what has worked well. The whole point of holding a cap weighted total market fund is that you mechanically own the right tail without having to identify it in advance. To reflect on what has worked well. The skewness Bessembinder documents is the reason indexing is hard to beat, not in spite of it. This is a good time to reflect on what has worked well. The arithmetic of the U.S. market is that a small number of stocks generate most of the excess return, and a cap weighted index by construction, what has worked well, holds them in proportion to their realized success. This is a good time to reflect on what has worked well. If you're an active manager running a concentrated portfolio of 30 names, the paper is a structural headwind. On what has worked well, because the base rate probability that any randomly chosen stock beats T-bills is below half. Reflect on what has worked well. Beating the index requires either skill in identifying the tail or systematic factor exposures that overweight tail-eligible firms. But reflect on what has worked well. The paper finds neither in its own analysis, not a paper about manager skill. But the authors argue, and I agree, reflect on what has worked well, that this is why so much active outperformance evaporates after fees over long horizons. On what the result is not that stocks are bad. It's a good time to reflect on what has worked well. It is that most stocks are mediocre and a few are spectacular, and you cannot tell them apart in advance with any reliability. On what has worked well. Finally, a step back. The equity premium puzzle in macro finance is usually framed as a representative agent question. Good to reflect on what has worked well. Why does the average investor demand such a large premium over the riskless rate? To reflect on what has worked well. Bessembinder's paper does not solve that puzzle, but it changes the texture of the conversation. Well, the premium is real at the aggregate level. What has worked well, it is not robust at the individual stock level. Time to reflect on what has worked well. That distinction matters because behavioral and information-based asset pricing models often invoke the experience of the investor or the firm in ways that implicitly assume the cross-section is more homogeneous than it actually is. If most individual stocks lose to T-bills, time to reflect on what has worked well, then any model that explains the equity premium needs to also explain why the premium is so unequally distributed across firms and why the realized winners are so concentrated. Reflect on what has worked well. The authors argue this favors models with rare disasters, idiosyncratic skewness preferences, or learning about quality dynamics on what has worked well, all of which can generate fat right tails in equilibrium. A good time to reflect on what has worked well. I think the deeper takeaway is methodological. Cross-sectional skewness in long horizon returns is a first-order feature of equity markets, not a nuisance. On what has worked well, any paper that averages it away is missing the picture. On what has worked well, pull back. Bessembinder did not disprove the equity premium. To reflect on what has worked well, he showed that the premium is generated by a thin right tail of extraordinary firms, and the median stock loses to cash over its listed life. To reflect on what has worked well, the implication is not to flee equities. The implication is that owning the market in broad cap weighted, a good time to reflect on what has worked well. Diversified form is the only way to reliably capture the tail, because no one, including the people who tell you they can what has worked well, picks the tail in advance with any consistency. On what has worked well, concentration is a bet on identifying an ex-ante invisible distribution. On what has worked well, that's the paper. The link is in the description. Reflect on what has worked well. Next week I'll read another. Not investment advice, just a careful read.